Hi everybody, Bruce Roth here. Thanks for coming to my webinar. And today we're going to talk a little bit about why it is that so many Americans are having trouble retiring. According to current statistics, 2/3 of Americans will never be able to retire. And largely this is because 80% of private companies have ended their pension plans. So if you work for one of those companies, you may have a 401k, but we're going to talk about how 401k isn't going to cut the mustard and give you enough for you to retire, why that is, and what you can do about it. So let's launch into the webinar here, and we'll go to the first slide. Okay, so here's the current reality that most Americans are facing, and that's that they're struggling to pay their bills. They can't save enough money to make any real difference. You know, they might be able to save 100 or 2 or 3 a month, but that's not enough to retire. And we'll talk in more depth about why that is. And like I said, 65% of Americans will never be able to retire. They're basically going to be working until they die. And if you don't want to be one of those people, you need this information. Okay, people struggle financially for 3 main reasons. The first is that they have too much debt. A lot of people, they went out and bought stuff on signature credit, or they have student loans or whatever, and they just can't get beyond their monthly payment on that, and it never seems to reduce the principal if it's signature credit. And that impacts their ability to save money. You know, if you're only able to save a couple $100 a month, it's really hard to save enough over 30 or 40 years to actually have enough to retire on. And we'll talk about why that is and what we can do about it. And the truth is most Americans are completely financially illiterate. They don't know anything about how money works. And hopefully we're going to be able to help you solve some of these problems and give you some information in this broadcast to get you started. All right, the next thing we want to talk about is it possible to save enough to retire? And so here's a couple of examples. Let's just say that you're going to save $100 a month and you're going to get a 6% return on that investment that's compounded annually. Now, that's an optimistic number. We thought it's generous. If you can do that, well, that's great, but let's see if you can and if it's even enough. If you do that for 15 years, it's only just under $28,000. If you do it for 20 years, it's a little over $44,000. If you do it for 25 years, it adds up to almost $66,000. You do it for 30 years, it's almost $95,000. So the question is, how long can you retire on $95,000, and how many years of retirement income do you need? If you only spend $30,000 a year, that's 3 years worth of retirement. You're probably thinking you want to be retired for longer than that. It's not nearly enough. So how hard is it to retire? Here's another example to show you the in depth. All right. So let's say you have 20 years to go until you retire, and you have $10,000 in savings. And you're able to save $400 a month, which is pretty decent. Not that many people can save more than that. If you can, great. We can talk about your specific details offline if you'd like. But let's just pretend for a moment that your current monthly expenses is $4,000 a month. Okay? So if you save that $400 a month on top of the $10,000 and you get a 6% rate of return, at the end of 20 years, it'll be throwing off $1,341 a month. So as you can see, that's not even enough if you're only spending $4,000. But if that $4,000 goes up by 3% per year, 20 years from now, it's going to be $7,224. So that's going to leave you almost $5,900 short, or $5,883 short every month, which means you burn through that $95,000 very quickly. All right, but now we're going to talk a little bit about investments, and then we'll talk about what you can do about it. Now, if you look at this, this is just a graph of what housing prices have done in Los Angeles from January 1990 through January 2014. If you see here, they went down during the 90s, largely because of the Clinton base closings, and there was a large drop in the number of people employed in aerospace, which is a big driver of employment in Southern California. So, but then they started going back up. You can see here in the late 90s, 2000s, and they went up to a peak. If you see here in 1990, the median price was just over 200,000, and at the peak it was like 640 or something like that, 640,000 or thereabout. Then it dropped precipitously, and then it went back up. As you can see, in January 2014, it's up at around 460 or so. And the truth is that now prices are already back up to where they were before the recession in Southern California. Now, let's look at the Dow Jones Industrial Average and compare that to the real estate. You notice prices went up a little bit, but not very much. They were more or less stable. And then when the economy started improving, they started going back up. And it wasn't, and they came down. They took a big hit here in 2002, largely because of the dot-com revolution going bust, or the dot bomb, as I'm sure you've heard it called. And as you can see, in 2007, this is where the peak was, and prices fell off in the stock market before they did in the real estate market. That's because that was more sensitive, but then they started going back up again. Now, if you'll notice, the two asset classes don't move in lockstep, but when the economy is doing good, they both go up. When the economy is doing poorly, they both go down. Okay, so let's talk about the implications of that for your investments. All right. Let's say in 1990 you bought a house at about the median price in Southern California, or we're just going to say $200,000. It's a little bit higher for the median, but we're going to say 200. So in order to buy that as an owner-occupant with an FHA loan, you would have paid $12,615.78 cash to close. So we're going to show that here on the real estate, and we're going to pretend that you had invested that same amount of money into the Dow over that time. Now, again, these charts end in January 2014, but you'll see that the present value of the stock is $81,596.25. That's pretty good. You had a total return of almost $69,000, or annual return of just under 22%. Compounded, it's only 1.82. Now let's look what happened if you would have put that money into real estate instead. Notice that you get a $200,000 asset instead of a $12,000 asset. So as that appreciates, you get that appreciation on the $200,000, and it applies to the amount you put into the property, so you get a lot higher rate of return. Notice you had $273,000 total return, which is 4 times as much as you did in the stock market, or 137% annually, or compounded 11.46. Now let's see you go to a stockbroker or a financial planner and say you want 11.46, they'll laugh at you. But we're going to show you how you can really do better. Those numbers are very realistic. They're very real world. They're what actually happened. But we think we can do better than that, and we're going to show you how. So in this strategy we're talking about today, we have 4 or 5 different ones that are related to this. But in this one, what you need most is to accomplish in order to finish strong financially is you need 2 things. One is you need a secure home with no mortgage payment for the rest of your life, for your entire life. And 2, you need a secure retirement income that will never run out. Like you saw that money that you saved, if you dip into it, you could easily run out of money. And I've seen that happen to people, and we have a way to help out with that. So the next thing we're going to talk about is the first investment. Now, you could have made this 5 years ago, or you're making it now. I went with $210,000 because that was the median home price in Las Vegas, which is my primary market. A few months ago, about a year ago, that's where the median price was. Now it's a little higher now. So if you put that $7,350 down, you'd have a mortgage of $202,000, and it would have a 30-year term on it. Let's look at the expenses. You'll see here $1,002.50 for principal and interest just for the mortgage, taxes on it, I just picked a property at random that was available, $96 a month. Insurance on that house would be $102 a month. And since you're getting the FHA loan and you're putting less than 20% down payment, you're going to have to pay mortgage insurance. That protects the lender in case you default, you don't pay your loan, and then they have to foreclose and they lose money. This insurance pays them back. So that's $143.54. And remember that. We're going to come back to it in a minute. And here in Las Vegas, most of the newer properties have homeowners associations. So we picked $30, which is pretty typical for one that doesn't have guards or gated community or any of that. So the total is $1,374.11 a month. That's how much it costs to get into the property. Now, there's tax advantages and all that. We're not talking about all that right now. Okay. So here's what happens to your investment, assuming a 3% rate of appreciation in the property, which we think is a very conservative rate of appreciation. 3% is low. Here in Las Vegas, the newspaper just reported last month that from January of last year till January of this year, that's from January 2015 to January 2016, we had a 9.5% appreciation rate, but we're going with only a 3% appreciation rate because we want to be conservative and show you how powerful this is, even if not everything goes perfectly. Okay? So if you notice here that after 5 years, the value of the property has gone up to $249,000 and change. You've paid your loan balance down a little bit, so you have $58,000 in equity. That's nice. Okay, look what happens 10 years, same thing, 128, 15. After 20 years, you have $314,330. That's pretty good. And your loan balance is down to $96,000, which means it's less than half of where you started at. And you only have 10 years left on the mortgage if you still are in that mortgage. But let's look at what happens after 5 years. Notice the total return on your investment, we have to subtract what you put in, is $51,067. That leaves 695% total return, or 47.3% compounded annually. Remember, we were talking about 11%, almost 12% on the example. But this is during the first 5 years, if you only appreciate at 3%. And if you want to know why, give me a call. I'll show you why the first 5 years is the best and how you can make that work to your advantage. All right. So now what we're saying is you're going to keep that first house. You're going to turn it into a rental property, and then you're going to go out and buy another house that's very similar to live in. We're not saying you buy a nicer house, you buy something more or less equal, okay? So the housing expense, we have $1,374.11, but the truth is that's going to go down by $154 or whatever the mortgage insurance was, because you're going to refinance out of that FHA loan to get rid of the mortgage insurance, and so you're going to lower your payment by $150 or thereabouts. The rental income right now on that house would be about $1,300. In year 5, it would be $1,492. So that would give you, even if you don't count the mortgage insurance, that's $118 positive. It's really going to be more like $260, $270. Okay, positive cash flow on the first day you rent it. Okay. Then after 10 years, the rent will have gone up, assuming only a 3% appreciation, which, by the way, again is conservative. Rents have gone up more than that since the downturn. And you're going to see $1,772, and at year 15, $2,104. See, the rent keeps going up and up and up. Now, we put here 2037 as the mortgage payoff year, but the truth is that if you take some of that money in positive cash flow and pay down the mortgage more quickly, you could be out of that loan much more quickly, okay? So here's investment number 2. Remember, we're making a lateral move, and after 5 years, the first property was worth $249,414. So we pretended you bought a property for exactly that amount, okay? Put $8730 down, and your mortgage balance is $240,000 and change. 30-year mortgage term. So let's look at the expenses on this second house. So the mortgage is $1,190.74, taxes $112, insurance $113, mortgage insurance, again, it's a new FHA loan, You only put 3.5% down payment, so again, you have mortgage insurance of $170. And again, we put $30 for the homeowners association. Again, that's a pretty typical one. That's where they just pay for the parks out of that. Okay, and then so the total is $1,615.74. Now, so that's more by $300 or so, about $300 than the first house. But we're hoping over those 5 years, if you keep the same job, your income will have gone up just because of inflation, and maybe you got a raise or promotion, I don't know, but you should be able to afford the $1,600. Also, your tax benefit's going to be a little bigger on this one than it was on the other one. Plus, you're going to have the positive cash flow from the other house. And I want to say this, there's an even bigger tax exemption off a rental house than there is when it's your own house. And if you talk to me, I'll be glad to explain that. All right, so let's look at what happens to the investment number 2 over the next 20 years. See how after 5 years you have $69,000 in change in equity, and then after 20 years you have $338,488. Now remember, this 20 years is 25 years into the process. Okay, so this is what you'd have on the second house 20 years into the process. You'd have $234,101. Now notice that you have we wrote reverse mortgage year and we didn't put any number next to it, and the reason is because we don't know how old you are. We can't talk to you. I'm talking to everybody on the webinar, and so I can't really say how old you are. But when you're 62 years old, you can get a reverse mortgage, and what that means is you never make another payment on the house. They pay you a monthly payment depending on how much equity you have. You have to have at least 50% equity. And if you'll notice here, once we get to here, 15 years in, your loan is 154 and your equity is 234. So somewhere between 10 years and 15 years, you pass that 50% equity and you could get a reverse mortgage. Now, if you're young, you may not do it till later, but again, I can't talk to that now until I know you personally, all right? But with a reverse mortgage, you never make another mortgage payment. If you stay in the house until you die, then your estate deals with it. And the way it works for that is if the house is worth more than the mortgage, your executor will sell the house and pay the mortgage off. If the house is worth less than the mortgage, they just give the house back to the lender, and they can't come after any of your other assets. So it's a pretty good thing. All right. So the next thing I want to do is talk about return on the second investment. Notice we're doing this one for 20 years. You have $329,000 of total return, or 3,777%. That's after 20 years. What chance do you have of doing something like that in your IRA or your 401k? None. And the annual compounded rate is 19.91%. Again, remember, that's on a 3% appreciation. Remember, what happened in LA is a little bit different because we had that major downturn like we've never seen ever in history. California's never experienced a downturn like that. And it also doesn't take into account the full upswing back. Okay? All right, so now let's look at both investments combined and look at a little bit about how that did. After 25 years, the first one you have $388,000 in equity. The second one, $338,000 for a total of $726,000, or almost $750,000 that you otherwise wouldn't have. And that's pretty good. And these are using very conservative numbers. If we see something like 5% appreciation, these numbers get much bigger, much faster. Okay, I wanted to use conservative numbers so no one could claim that I was overstating anything. All right. So here's the $64 question. How do you break the chains that you have to your job? Because most people can't create an asset that throws off enough income that they can give up their day job. That's why people are going to be working until they die. So we're going to talk a little bit about your path here, okay? The Roth Properties Group has created the Life to No Money Worries plan, and we will guide you to this better life. And the strategies we use include some of these and even some that are not on this page, but we're going to do mortgage planning for you. And what that means is We look every year, once a year, we do a complete review of everything. And if your mortgage interest rate is right, we tell you to stay there. We might tell you to pay it down. If you're paying a high interest rate and there's nothing better in the market, we might say pay as much into that as you can instead of saving the money on the side. So we have to look at you that year to help you decide. The next thing is we're going to help you reduce debt. If you have debt outside of, your mortgage, like you have student loans or you have credit card debt, we're going to help you create a plan to reduce that debt. And we're going to combine that with a savings plan. It may be better to pay off your credit cards. It may be better to save the money. We're going to help you figure that out. And that there's no cost to you for any of this ever. We only earn our money by helping people buy and sell and lease real property. Okay. We're going to help you try and maximize your cash flow on the property or properties you have and improve your rate of return, which may include getting a new loan. It may include selling and buying a new property. We'll have to consider that at the time. And so we use a number of investment strategies also to help you maximize your tax advantage. I'm going to talk about one strategy right now. That's all I'm going to go into on the strategies. Is there's a 1031 tax deferred exchange. So if you have a property that's an investment property, so let's say 2 years after you rent out the first house, if you sell that house at any point after it's been a rental property for 24 months or more, you can take the gain in that property and roll it into another property and pay no taxes on the gain ever, as long as you keep doing a 1031. And you can do it again and again and again. And then when you pass and you leave the properties to your estate, to your heirs, here's another strategy that's connected to it. They inherit the properties at what's called a stepped-up basis, which means that they, if it's now worth $5 million, then it's as though they bought it for $5 million, and they can then start depreciating it and all that, and they can again use 1031 to never pay any capital gains themselves and leave it to their children. And the truth is, that's how the rich stay rich. And if you want to get on that train and get your family on that train, I would be glad and grateful to help you. So we have a lot of ideas here. Please call me at area code 702-277-1303 or write to me at lasvegasbruce@gmail.com. That's LASVEGASBRUCE@gmail.com. Thank you for your time. Good luck.